About a year and a half ago, the Fed did decide to review its monetary policy framework and make necessary adjustments due to some of the difficulties it was having in achieving its objectives. And I think it's important to take a look as to why they felt the need to review its policy. The Fed formally adopted a 2% target rate in 2012, but since that time has not been able to meet its stated goal, missing to the downside pretty much the entire time the goal has been in place. Since the beginning of 2012, inflation has averaged 1.6%. And this is important because if the central bank targets a 2% inflation and consistently falls short of that target, expectations about future inflation will slide, making it much harder to achieve that target in the future. And when people believe that prices will decline in the future, they tend to delay purchases. And this does become a self-fulfilling cycle that results in even lower inflation. So to combat consistently missing these inflation targets, the Fed is now formally adopting average inflation targeting. This means the Fed will now allow inflation to rise moderately above the 2% target for a period of time to compensate for consistently undershooting the target. I want to note, however, the Fed did not announce what period of time they would take into account to average this inflation level. The pandemic has further exacerbated pressures on the economy, with lower prices, elevated risk for weakness in the labor markets, as well as the great deal of uncertainty in the economy. So basically everything is pointed to, and does continue to point to, extremely dovish Federal Reserve policy. There are definitely clear implications for monetary policies with the shift. A shift to the flexible inflationary targeting reinforces the Fed's low for long message. The Fed's latest economic projections, which were released in June, shows PCE inflation at 1.6% in 2021 and 1.7% in 2022. This suggests it will be years before inflation rises to the 2%, let alone exceeds that mark for long enough to bring average inflation to an average of 2%. In those same projections, only 2 FOMC members saw rates above the current levels at the end of 2022. This shift to average inflation targeting is a pretty clear signal that with all other things being equal, that interest rates will remain at around zero for several more years.